Good morning. Welcome to America First Wealth Management Investment Outlook Podcast for July 8th, 2024. My name is Dan Liu. I'm Chief Investment Officer and Portfolio Manager. And joining me today, once again, is Micheal Cheah, Head of Fixed Income and Portfolio Manager. And then next slide, Michael. This is our standard disclaimer. Please read it at your leisure. We're not giving any investment advice. We're just giving our thoughts on the current market and our outlook. And once again, reliance upon information is at the sole discretion of the viewer. And our views are subject to change. And this is based on the latest data. Next slide, Mike. So for the week ending July 5th, which was the abbreviated week with the July 4th Independence holiday, it was a relatively strong week. As you can see here, the S&P 500 up almost 1.7%. NASDAQ was up over 2%, along with the NASDAQ 100, also over 2%. Russell 1000 growth continued to be very strong, up 3.7%. Value and small caps continued to lag. International stocks, as measured by the MSCI EFA ETF, was also up over 2%. And bonds rallied up 84 basis points, as measured by the iShares Core Aggregate Bond ETF. Next slide, Mike. So I wanted to show this slide here because everyone's talking about Biden versus Trump, and a lot of press there. Just want to show from the perspective of the S&P 500, months in office for the S&P 500. This is normalized at 0 at the beginning of the term. So Biden's in the blue, Trump is in the dashed red. And they're pretty much neck and neck in terms of performance at about 43 months in office apiece. So from the perspective of the markets, both Biden and Trump have similar performance at this point, with Biden just lagging slightly. But I just want to point that out. Usually people will vote their wallets, and the wallets are, as measured by the S&P 500, are suggesting that there's no clear winner here. Next slide. Turning to Treasury yield, we did have a drop of 8 basis points during the week, and I'm sure, Mike, you're going to be talking about it, driven largely by the jobs data that we saw last week, which triggered a drop in rates and a spike up in bond prices. Year to date, though, 10-year Treasury yields are still up 40 basis points, but again, that margin has dropped a little. I show the 10-day moving average here in the dash purple, which clearly shows that rates are trending down, because as the actual rates cross the 10-year bond yield, that's always been a bullish signal. So just wanted to point that out. Mike, and we're going to turn it over to you now to talk about your piece.
Okay. The bond market done well because of the economic data that came out. Initially, when we read about the U.S. job opening unexpectedly increased from a 3-year low, right? But you'll see that the uptick is not a big deal. Okay, right? It is when you look at it on a longer term perspective, you see this steady decline in job openings, and we see the unemployment rate start to move up very gradually. And the big move came on Friday when we have our job data, payroll changes at establishment on a 3-month moving average. You see this very steady decline here, right? Which is what the market is looking for. And another good news is the average hourly earnings on a percentage change annualized basis, 3 months. We see again a very gradual decline. right? A lower increase in average hourly earning means lower wage inflation and lower CPI inflation. On a year-on-year basis, the average hourly earning is now below 4%, right? Yes, there's some room to go before we get to 2.5% or 2%. Nonetheless, the market is happy with this trend here. And the unemployment rate went up a little bit to 4.1%, as you can see here, right? However, to be sure, we need to superimpose this unemployment rate with the red line here, the non-cyclical rate of unemployment, which is also known as the natural rate of unemployment. Okay? In every country, there is a certain percentage of people who who do not want to work, or no matter how much money you pay them, it's just a lot of difficulty getting them to work. And if they do work, the productivity tends to be quite low, right? So we have been below the natural unemployment rate for quite some time. And as you can appreciate from this historical chart, when the actual unemployment rate rises above the natural rate, we get a recession. You see a recession here, right? Okay. So the important question here is whether the Fed is going to wait until the unemployment rate crosses the natural unemployment rate, or would the Fed jump ahead, expecting this to continue, right? So this leads on to monetary policy. We have this news here where major banks say that the Fed could slash rates by 200 basis, right, over 200 basis point. Okay, right? It's not 200 points, 200 basis point over 8 straight meetings as the economy heads for a sharper downtrend. Right? And uh, on a global basis, what we are seeing is also expectation that because the global manufacturing PMI has declined, okay, this is the inverted chart, decline, right? So so we see that the expectation is for the number of central bank around the world to start to cut rate, right? So the question then is, will the money move away from the U.S. into non-U.S. Because the other central banks are cutting rates faster than the Fed, earlier than the Fed? And this is understandable because it was the other central bank that raised rates before the Fed started raising rates, right? So the bond market, what's interesting is that after the debate, we see the 2-year remain unchanged, but the 10-year yield has moved up. Okay, right? Why? Well, the two interpretations. The first one is that if Trump get reelected again, he had talked about tariff, which is inflationary, and the idea of having tax cuts that are largely unfunded, that would mean that we are going to see an even bigger fiscal deficit on top of the huge debt that we have, right? The other interpretation is that during the entire debate, neither candidate had talked about addressing the fiscal deficit and the debt problem, right? So it's understandable why the market has reacted this way. Moving on to energy, right? We see how the oil price, the Brent crude price, is trading above the 200-day moving average. Question then is that will it sustain the move up? And if it does, then it will obviously be inflationary. Okay. And here you have a an opinion, right, that the XLE is moving out of the downtrend channel and touching the major resistance line here. Question is, if this trade up, led by higher oil price, again, this is some signal that we are watching out for. Okay. Now back to you, Dan. Dan, you're muted.
Sorry about that. Before we continue, I thought it'd be useful to ask you, Mike, a few questions.
Yeah.
As we know, the primary mandate for the Fed is to control inflation. Jobs and economy are probably secondary or tertiary.
Mm.
But we are at a critical point. It's a very heated election period. And the question is, what will the Fed focus on for their rate decision? Because, as you've noted before, core inflation, although has receded, it has not dropped to their 2% target level. And certainly last week's jobs data caused a huge rally in bonds and a drop in longer term interest rates. And at the same time, we're seeing record treasury issuance and lack of demand.
I think it's important to bear in mind.
Yeah. So, at the same time, we're seeing a lot of treasury issuance, as I mentioned.
Yeah.
So
Very
there
true.
seems to be many cross currents. And as someone swimming in these waters, I'm not sure if the water's pushing me back to shore or dragging me out to the deep end of the ocean. So it seems to be a very unusual time. And it really depends on what the Fed is going to focus on in order for them to make a rate decision. And it seems like if it wasn't an election here, the safe choice would be to keep rates high and to talk rates higher. However, you are in a strange time. So what are your thoughts about that?
Well, I begin my analysis with exactly what you say about the supply-demand situation in the bond market, right? Clearly, supply is growing, right? And the demand from the sticky investors, the core investors like the Federal Reserve, during QE, foreign central banks, okay, that's a decline, okay, and continue to decline. So the question is, who is going to step up to be buying all this supply, right?
Yeah.
And also important to understand bond match, okay? With the 10-year yield at around say 4.5 and the Fed funds at 5.25, we are having a huge negative carry, right?
Yeah.
So if we are running a hedge fund, we are funding with short-term money to invest in long-term. Every day it costs us money, and we need a huge capital gain to offset this negative carry.
Yeah.
So the important thing is timing, right? When do the bond investors expect the Fed to cut rate sharply, quickly? Right? If some market participants observe or speculate that the Fed could cut rate by 2% from 5.25 to 3.25, then we get back a normal yield curve. Then this could rally quite sharply, right? So having said this, the whole framework that I'm resting on is how soon will the Fed cut rate? And as you have mentioned, the question is, will the election year affect this Fed decision? I totally agree with that. On top of this, I want to say that I was wrong and I did not expect the Fed in the last year to, out of the blue, pivoted to talk about cutting rates 3 times into 2024, right? to me a huge shock, because the numbers clearly do not justify that kind of. Is that Power has talked about very specifically many times that he and his team will not repeat the mistake made by Arthur Burns, that cut rate too soon and end up a resurgence in inflation. And the Fed at that time paid a heavy price for that mistake. So he's talked about that, and yet they pivoted out of the blue to 3 cuts. And guess what? Okay, the numbers proved them wrong, and they were forced to pull back from 3 to 2 to now 1 cut. Right.
Yeah.
So I would be shocked again if the Fed did not learn the lesson from last year in trying to be too early. Because when they are too early, they would re-accelerate the economy.
Yeah.
And when they re-accelerate the economy do not have time to rest, do not have time to allow inflation to follow through its trajectory down. And that means that if they are wrong, they would, if they cut rate once, they may have to raise rate 3-4 times. So I will be shocked. I will be shocked if they did not learn the lesson from last year.
Yeah. Well, to be fair, they didn't actually cut rates. They used the power of moral suasion and just talked about cutting rates 3 times. So
yes, and that kind of signal to the market could be very real. Could be very real to the market, and the market did rally.
Yes. That's probably real to the markets, but in terms of people running businesses and planning long-term spending and financing, talk is cheap. Real rate changes are what they bank their finances are, and banks also finance based on what the real rate changes are, not dependent on what the Fed is saying. It's based on reality. So the reality didn't occur, and the markets acted on the hyperbole, which I think is very important to understand and assess and analyze. And I'm glad we do this, because we play in the markets, and we have to make sense out of what could be fantasy and what could be reality, and you know, we are playing in very interesting times. So anyway, turning to stocks, the Magnificent Seven. The big move for the week was Tesla, as you can see, up 25.5% for the week, largely due to their delivering higher than expected cars versus projections. And I have another slide on that showing the big pop. But now you can see that the Magnificent Seven is truly almost once again the Magnificent Seven, with Tesla just down 2 basis points year to date, and all the other Magnificent Six names are up very strong. Nvidia also turned in the green for the week after being down for, I think it was two straight weeks in a row. So we had just solid performance by the Magnificent Seven. Next slide, Mike. And I wanted to highlight again a slide I showed last week, just as a reminder. First half of July has been the best 2-week period for the S&P 500 since 1928. So we just had the first week being strong, and hopefully we're going to have a repeat for the second week of July. So I just wanted to highlight that. History is proving to be a good guide here. Next slide, Mike. Oh. In terms of the sector performance, consumer discretionary was the top performing sector. Not surprising, because Tesla is, I believe it's the number 2 name in the consumer discretionary sector. So that clearly drove it, followed by the technology names, communication services. Lagging for the week were energy and healthcare being the bigger underperformer. Materials were also down. Next slide, Mike. terms of various factor performance that we've also been tracking, at the top were the Invesco Global Listed Private Equity Index. These are companies that were previously private and went public. And then the IPO names were also very strong. Quality names were up. Buybacks were lagging, and I think that tends to be a function of many of the companies performing buybacks enter into a blackout period before and after the quarter end, and they cannot be buying back stocks until a few days after they report earnings for the quarter. In terms of style, we did mention that large growth was the winner. Russell 1000 ETF clearly showing that. Momentum stocks were strong. Small caps lagged at the bottom, and value stocks also continue to lag. Next slide, Mike. In terms of commodities, and here's where we're trying to focus on getting some predictors of inflation, and energy's clearly been rising, largely due to a number of the OPEC countries are holding on to their quotas and not excessively exceeding their quotas. And also we have the gasoline demand driven by the summer driving season. So we do see higher gasoline prices, but people are driving, enjoying their summer vacations. At the bottom, we had a despite the drop in interest rates, we did have a strong rally in gold and silver, and a nice pop in copper, which is up over 5.5% for the week, and a little rally in aluminum as well. So it could be a sense that the oversupply and inventory of copper and aluminum that we talked about is starting to abate with the pickup in copper and aluminum prices. Steel continues to lag, so it could be that larger projects are being delayed because steel tends to be associated with large construction projects. Next slide, Mike. On the agricultural side, cocoa picked up again, up for the week. It had dropped for the last 2 weeks. We're seeing some increases in many of the agricultural commodities for the week. At the bottom, though, cotton, sugar, and rice were down a bit. Next slide, Mike. As I pointed out, Tesla definitely was the stock of the week, and I wanted to show here it's broken the downtrend lines we've seen in Tesla. And at the bottom, I highlighted the very high short interest. So I think there was a positive surprise on deliveries, coupled with an overcrowded short position, and so Tesla rallied extremely strong. Let's see if Tesla can follow up with good earnings when they report, I believe later this month. Next slide. People have asked me, are the markets overvalued? And I have said, it doesn't seem that way, it doesn't feel that way. And by the historical PE chart that's showing here in the last 30 years, the PE is not extended as it was seen in previous times when the markets have pulled back. I would say we're about halfway through an overvaluation situation. So I think from a historical PE basis, we're not overvalued. Next slide. And also from earnings expectations, forward earnings expectations are up 8% in the US. And this is showing things from an international basis. Also in Japan, forward earnings are also expected to be up 8% as well. And then we're seeing upwards revisions in some of the other international markets, but it's pretty clear that US and Japan are leading. So we've got reasonable PE levels and increased earnings expectations. So to me, that points me to being constructive in the equity markets here. Next slide, Mike. One thing that continues to concern us is that the breadth of the markets is being led by, and this chart shows top 10 biggest stocks are contributing to 77% of the S&P 500's return in the first half of the year. And this is the second highest reading of that number. The only other time it's been higher was in 2007. Next slide, Mike. Another view of this is the record low percentage of stocks beating the S&P 500. It shows that a very small percentage, about 25% of the S&P 500 names are beating the actual S&P. So it's a very low percentage. There's just not a lot of breadth. Active managers, in order to keep up with the S&P, just have to be very concentrated in the top 10 market cap names. Next slide, Mike. Now, here's something that we picked up that could show signs of recovery. Inventory is very destocked. Day sales of inventory are near record lows. This goes back to 1997. So day sales of inventory year over year are really down a lot. So companies are very low in inventory, and they probably need to catch up to build stock. And that could be a reason why we're seeing some of the metals commodities like copper and aluminum starting to pick up in price. Next slide, Mike. And then global manufacturing PMI factory activity is showing a bounce. So that's kind of, I think, a little confirmation that there's definitely a inventory replenishment cycle occurring here. Next slide, Mike. Turning to the economic calendar for the week, the big event, in my opinion, will be Tuesday. Fed Chair Powell will have his testimony before Congress, 10 a.m. So that's important to listen to see where his thoughts lie on the Fed's views on inflation, the economy, and jobs numbers. Next slide, Mike. Again, he's got another speech on Wednesday. The usual data that we expect on Wednesday: mortgage applications and energy inventories number. A lot of Fed speeches, so a lot of noise that we need to wade through from the hyperbole. We should hear more about that. We also have wholesale inventories month over month, so hopefully we'll see some improvement in the inventory, or further degradation should trigger more inventory restocking and manufacturing. Next slide, Mike. Big number will be on Thursday. This is core inflation number, which will hopefully settle the debate in terms of what does the market care more about? Is it jobs, is it economy, or is it inflation? So expect a lot of fireworks on Thursday, even though it's a week after 4th of July. This will be the fireworks in terms of the bond market. We also have a number of auctions occurring. So a lot of, and also jobless claims. So we're going to see what happens with this spate of data that's coming out on Thursday. Next slide, Mike. Then on Friday, we've got the PPI numbers and Michigan sentiment, and then some of the usual data that we normally see on Friday as well. Next slide, Mike. In terms of earnings report this week, it's largely focused on Thursday and Friday. Got Delta, Pepsi, Conagra, and Progressive. And on Friday, we've got some of the banks coming out: BNY Mellon, Citigroup, JP Morgan Chase, and Wells Fargo. And we have Fastenal, which is a industrial component supplier, that should give us some indication on demand on manufacturing. And that brings us to our last slide, Mike. And once again, if there's any questions or comments or interest in chatting with Mike or myself, please contact Cleveland Ashley. His number and contact information is listed here. Once again, this is our weekly investment outlook podcast. And we're here to help our investors and clients and prospects. So please feel free to reach out. We'd love to hear your comments and feedback, and hope many of you are finding this information useful and a guide to what's happening in the recent past and what's coming up this week and our thoughts about the future. So anything you want to add, Mike?
Just, we are here to help, and in this hot summer weather, stay cool. Right?
It is hot out there. Some parts of the country, I think, are hitting 124 degrees.
Yeah, crazy.
Unseasonably hot.
Crazy.
So stay cool, everyone, and we'll keep our heads cool for following the markets. And hopefully the second week of July will continue the strong performance we saw last week. So thanks for tuning in, and have a great week, everyone. See you next week. Take care.
Bye. Bye.